Our chairman has a very tight schedule, and our finance minister has a meeting with him at 12:15, so he'll have to leave at 12, and then I'll sit in his place and run things. So Subhash, again, needs very little introduction. He's Secretary, Department of Economic Affairs, has held a series of important positions in government, the last one being the Executive Director of India to the World Bank, and so brings both international and tremendous amount of Indian experience to the job. He also happens to be a member of the governing body of NCAER, though we haven't yet claimed his time on that score a lot, and we look forward very much to this particular session. So, Subhash, it's all yours. The rule is between 25 minutes for the author, 10 minutes for the discussants. You may have to leave by that time, but after the discussants, we open it up to the floor, and then at the end, we give a little time to the discussants. So, Subhash, all yours.
Thank you very much. I must apologize. This is something which I couldn't avoid, that meeting at 12:15 to discuss one of the most important policy measures these days. So I'll have to leave at 12:05, but we have 45 minutes between us, and then Shekhar takes over. So without much time being taken for this paper has been written. I've also had a good look at it. There's a lot of good analysis of the Indian economy, what these challenges are, and what can be done possibly to do to take care of this recent slowdown, which is showing the sign of pickup, basically concentrated in the investment side. So let me request you to make the presentation straight away, and then we have the discussants. And in the meantime, when opportunity comes, I'll also offer some comments. Right. Thank you.
Sure. Thank you very much, Shekhar, for inviting me again, this time with co-authors primarily from the World Bank. Junaid was planning to be here by 11:30, so I guess he'll arrive a little late. Florian isn't here, he's in DC. Dhruv is here, who'll take up questions, perhaps bilaterally, on any data-related issues. Usually I start my presentations with a joke or two, so none of that today, because I've been strictly told to finish in 22 minutes. India's growth story. So why did we write this paper? This paper was written as a part of my job, which I have been doing in the past 1 year as the lead economist on macro issues for India. And it started in the quarter when growth rate had fell to 5.7%, and many obituaries were being written on India's growth potential. We were asked to comment on those data points as well. And the senior management was very interested. World Bank has a huge portfolio in India, and they wanted to understand what's happening to India's macro story. So when we started looking at it, we couldn't just look at a few quarters. And we started going back to understand how does this 5.7% number figure in with medium-term timelines as well as the long run. And we ended up actually looking at 50 years of data, the entire time series for which there is credible macro data. The paper is not econometrically very heavy, though we do have some difference in difference estimates. The main approach is actually to look at long time series, to look at inter-country comparisons, interstate comparisons, and in some ongoing work, particularly on investment slowdown, we are also looking at some firm-level data, which is not a part of the paper. So because of the way we are looking at the data, we divided the paper and therefore today's presentation into 4 parts. India's long-term growth, and there we are looking at a period of 50 years when we look at the data at the national level, and 40 years when we are looking at the state level data. And then we observe a specific dynamic, economic dynamic, starting in 2003, in the last decade and a half. We analyze that period very carefully and in great detail. And many people, eminent researchers who have worked on this period are not unfortunately here, but they include Arvind Panagaria, Shankaracharya, Rakesh Mohan. They have all written about this period. Dr. Rao and Sudipto Mundle, they have looked at the policy response as well during this period. And I'll be referring to that. And then we go from 50 years to 15 years, and then we look at high frequency data and we ask what's happening in the last few quarters. Remember, that is how this entire paper started. And we talk about emerging challenges and the policy priorities. But in view of what the Minister Prabhu said just now, it's humbling actually that we can get away by talking about these priorities because we are not in the murky business of implementing them. But nevertheless, so one of the main observations of the paper, again, as I said, nothing econometrically too heavy, we just look at last 50 years of GDP growth, and we observe a couple of trends here. One is that long-term growth has consistently accelerated, and it has stabilized. It has stabilized in the sense that the variations around the long-term growth have become smaller, and this is also borne out when we look at 10 years rolling standard deviations or 10-year rolling coefficient of variations. So in the long run, actually, India's growth story has evolved in a comforting fashion. When we compare this trend growth rate, as I said, nothing fancy here, but we have a positive trend growth rate. When we compare it with other countries, except for a couple of them, we are not able to find this steady acceleration being a norm in other countries, be it Brazil, be it Mexico, Thailand, Indonesia, you can name it. So growth has not been as steady as in India. And this acceleration is even more evident in per capita income since population growth has slowed down. So you see a faster acceleration in per capita income as well as it becoming steady as well. We look at the decomposition of GDP, and we do that in a number of ways. We look at growth across sectors, the broad sectors of the economy, agriculture, industry, and services. We look at the composition across uses, consumption, investment, and exports. We do the decomposition. Barry Bosworth was going to be here, I understand, and he has done a lot of work on that. And what we find here is that there are very few surprises in the sense that we see some amount of acceleration and steadiness across sectors, across uses. So agriculture sector's growth rate has become more stable. There is no definite acceleration, but stability is pronounced enough to make it a more credible contributor to growth. Services growth has become stable as well as it has accelerated the fastest. Industrial growth has become stable as well, and there is some acceleration. Now here too, the Indian experience actually differs a little bit from many other countries in the sense that growth has been more concentrated in other countries. In terms of consumption, investment, and exports, again, for example, unlike China, where it has been written about that until recently, the growth was mostly driven by investment. In India, it has been more evenly distributed. And another way people look at growth is its decomposition into input, use, and productivity growth. And there too we find it's a more balanced narrative than, for example, used to be the case for China. Growth is contributed to both by factor inputs as well as productivity growth, be it total factor productivity or labor productivity. We carry out this exercise at the state level. And we see that an average state has accelerated and its growth rate has stabilized. And this is something very, very recent we did. So we actually plotted these charts, the kind we saw for the national economy across states. And we have just picked up 4 states, but for most of the states, we see a similar phenomenon, which is growth acceleration. And even more interestingly and more clearly, we see growth becoming stable in the sense that its 10-year standard deviation or coefficient of variation is declining. So in that sense as well, growth seems well balanced and well diversified. So now that was the long-term story. So long-term we see growth accelerating, becoming more stable, it being rather well distributed across sectors, across uses, input use and productivity growth. It seems to be borne out in state level data, and average state is growing and is becoming more stable as far as its economic performance is concerned. And from there, we move to the last 15 years. So what have been the more recent dynamics of growth? And here we see a very distinct pattern. We see that growth was unprecedentedly high between 2003 to 2008. And as I said, many people have written about it, and it may not come as a surprise to those who have been reading this alternative work. So growth accelerated to 8.8%, something that was not seen before or after in India. And since then, since the global financial crisis of 2008, it has now come down to a level of 7.1%. At one level, if one were to ignore the short period of 8.8%, it seems aligned with the long-term growth rate, right? So there is nothing alarming here in that sense. But let's focus on this 8.8% a little bit more. So there is a distinct cycle in the Indian economy in these last 15 years when growth was faster than ever before or ever after. And then it slowed down. So what is interesting about this is that growth was somewhat faster in India during this period than in many other emerging markets. And there were specific components of the GDP which grew the fastest. And I'll come to that in a second. Others have written about both external factors as well as domestic factors contributing to that growth rate. Among the domestic factors, Arvind Panagaria and Shankaracharya have written about it being the cumulative impact of reforms that were undertaken in the previous decade and a half. And among external factors, this is the time when the global economy was booming. And most economies, whether advanced, whether developing countries in Africa, whether emerging markets, they were all growing very rapidly. There was a large amount of capital that was flowing into these countries, making the financing of this growth possible. In the Indian case, it prominently reflected in a very fast growth rate of investment and credit, and as well as into rapid inflows of capital. So some may argue, and this is the line we are taking, that when investment and credit grow at the levels that we see in India, more often than not, they turn out to be unsustainable. So there is a distinct boom and bust cycle, if you wish. So this is to look at the global factors behind that very rapid growth. The chart, the scales are different. The left-hand side chart puts India's growth rate against the world growth rate, and what is striking is the co-movement. India is a highly integrated market, not just on goods, but also on capital, somewhat on labor. It relies on international markets for its energy needs, etc. So what happens globally impacts India, and we have reflected on it in some detail in the paper. So when we talk about the Indian economy in the last 15 years, we very much need to look at the global factors. But even so, when we compare other emerging markets with the experience of India during this boom and bust cycle, we find that growth rate was more rapid in India than the 7 of the largest emerging markets, not including China, or a larger set of emerging and developing economies. We see that in domestic credit, we see that in investment growth. So there was something India-specific going on as well. This is just another chart. Investment slowdown is an important part of this correction in the economy. So this is just comparing, blue line is India, very rapid increase in the rate of investment, and a much sharper decline in the rate of investment afterwards. So since then, after this short period of 8.8% growth, which actually comes back now when we talk about our aspirational growth rate, we talk about 8% or going higher to double digit. And the only precedence that we have in last 50 years is that 5-year period. So slowdown in India coincided with the global financial crisis. And slowdown has been most prominently evident in investment and credit, exactly the parts of the economy which were growing very rapidly prior to the crisis. And the pace of recovery also relates very well to the policy response during the crisis. Now here, there is an interesting angle and an India-specific story, 2009 being the election year. India perhaps over-responded to the crisis. And this we have done elsewhere, not in this paper. We look at the fiscal response of India, and we compare it with the fiscal response of about 20 emerging markets. And India clearly over-responded. Its fiscal deficit increased by 4.5 percentage points of GDP in 1 year. There was monetary policy easing, I think, of the order of 400 basis points interest rate. Pay commission came around the same time. There was an expansion of NREGA. There were tax rebates given. Interestingly, banking sector, which is predominantly public owned, was asked to roll over credit as a part of this entire policy response. And it's possible that some of the issues that we are seeing in the banking sector currently have underpinnings in the response that was adopted. Now, since then, so there are two things that I want to talk about here. One is that the policy response that we saw in 2008-9 had two impacts. One, it, for a short period, brought the growth rates up to some level. I'm forgetting what that level was, but the recovery in GDP was slightly sharper than in other countries, and it's no wonder because the response was large as well. But at the same time, and others have written about it as well, eventually it resulted in macroeconomic instability. So when macroeconomists talk about macroeconomic stability, we look at 4 or 5 indicators: current account deficit, fiscal deficit, inflation, real exchange rate, etc. All of those variables started worsening around 2010. And that resulted in a mini crisis of its own in 2013. So this policy stimulus was not without cost. It did bring up the GDP back for a year or two, but eventually it resulted in a crisis-like situation. But more importantly, which parts of the economy have slowed down as a part of this correction? Investment rate has been slowing after peaking in 2007, 2008. As a percentage of GDP, it hasn't yet started recovering. Credit growth, when I said there were elements of unsustainable boom, a credit growth rate of 30% or so is considered very high for an economy with the kind of financial sector it had and with the kind of per capita income it had in the mid-2000s. And since then, credit growth has been declining. There has been a recovery in the last few quarters, but that notwithstanding, credit to GDP ratio has been in a declining mode. And worrisome, and it's related to Minister Prabhu's short discussion with us, and I think it will be discussed by Sajid tomorrow in his paper on exports. Exports to GDP ratio has been declining, and this is something I'll reflect on a little bit more because it's an important part of the story of ongoing slowdown in the economy. So 3 worrisome features of this slowdown are that they're reflected in credit growth, investment, and in exports. Now, coming to the recent economic developments, just the last few quarters, we started out with trying to understand a temporary slowdown of the economy to 5.6 or 5.7%. Since then, there has been a recovery in the economy, and this recovery is evident across sectors again. It has not yet resulted in a full reversal of the long-term declining trend or medium-term declining trend in trade, credit, or investment ratios, but it's evident sufficiently in many other parts of the economy. So this is here we are choosing a shorter period to put in perspective this recovery. And we say that economy is rebounding. It's evident in GDP. It's evident across sectors. We are just showing some of the sectors here, but it's evident in other sectors too. Manufacturing was one sector impacted disproportionately by the demonetization and GST. There is a definite reversal there. Construction activity, which again was impacted, is rebounding. We see credit growth picking up. I alluded to that earlier. Investment growth is accelerating as well. So in the short run, there is a revival in the economy. It's evident in exports, PMI indicators, etc. But the question is whether this revival is going to last, whether it will be strong enough to reverse those declining trends that we saw in important parts of the economy. and whether they will be able to take the economy above its trend growth rate of 7.5%. And here in the paper, we look at these three parts a little bit in detail. We see that investment rate has declined for corporate and household sectors. The first paper this morning was on declining financial savings by households. We see that in the data as well. And there is no definite reversal there as yet. India's export story actually is more worrisome. Export growth of both services and goods has slowed down, and slowdown has been sharper than that in the global volumes of goods and services exports. So as a result, India's share in global exports has been stable or actually declined for some time, and now it's stabilizing. And we decompose the exports growth rate in terms of destinations and different sectors, and we find it quite widely distributed. Exports have slowed down to most destinations. So it's not a story of, let's say, oil prices that Middle East is not doing well. In fact, somebody put that hypothesis to us, Aditya Matu at the World Bank, oh, it's all about Middle East not doing well and therefore India's exports suffering. So we did this decomposition, and it's actually exports to all different destinations which have slowed down. And we also see it across sectors, which points to there being domestic factors behind the slowdown, not just the external sectors. On the banking sector, actually, we just have a few slides here, just a couple of slides. Credit growth, as I said, has been declining. One very distinct feature of India's banking sector is that it remains predominantly public sector. Nothing wrong about it. It's just that there is a very definite distinction between how public and private sector banks have been performing. So NPLs have been higher in public sector banks. Credit growth has been slower. Abhijit Banerjee has done a lot of work, and in one of his papers, he calls the public sector bank employees as lazy bankers. And perhaps there are reflections of that here. What is striking is that while many other sectors have a more mixed ownership structure now, which includes telecom, which includes aviation, public sector banks remain predominantly, banking sector remains predominantly public sector bank oriented. So no causation or correlation implied, but there's some food for thought here. So just to wrap it all up, and I'll reflect on just one more thing here. India's growth rate over the long run has been very credible. There are very few precedences that we see in other emerging markets or developing economies. East Asia, some of the East Asian countries being an exception, South Korea and China, etc. But if we compare it with other countries, we find India's experience to be quite credible. Growth rates have accelerated, they have become more steady, they are diversified across sectors, across regions, they are balanced. Growth has averaged to about 7% in the last decade. That seems to be the new norm for now. 7.5% is what we call it, as growth decelerated after a temporary boom prior to the global financial crisis. A decline before 7.5% was transitory, and economy is now rebounding to its trend growth rate. Growth at higher levels would require a whole lot of structural adjustments. It will require also a supportive global economy, and that's what I'll reflect on a little bit. It will require investments and exports contributing to growth. Even in an accounting sense, if these sectors do not grow at the rates they're required to grow, there is only so much growth you can get out of consumption. It does require a modern and supportive financial sector, and that I think right now is perhaps the weakest link in India's growth story. But coming back to the global economy, and this we don't have yet in the paper, this story has evolved only in the last few weeks. So there are three challenges that are simultaneously impacting emerging countries such as India, and Minister Prabhu reflected on those. Trade protectionism is no longer a rhetoric, it is an outright trade war. monetary policy tightening by the US, not yet by Eurozone, but that may come soon as well, and oil prices increases. So oil prices increases have taken most of energy specialists by surprise. So when we talk to the experts in the World Bank or elsewhere, it has been a rather unpredicted increase in oil prices. And unfortunately, all three of them matter for India. India wants to integrate more on the trade side. India is a large open country when it comes to financial sector. So monetary policy tightening by the US impacts India. And India is an energy importer. So all these three factors have come together, and they may impact the dynamics in the short run. But these are cyclical as compared to the cyclical structural factors that I have just talked about. So I'll stop here. Thank you.
Thank you, Poonam. You finished exactly in 22 minutes. Great time management. Very accurate, I think, succinct, comprehensive, balanced analysis of Indian economy performance for the last 50 years. And more recent, I think it was without any biases, opinion, so it does represent a very good analytical note for information and for taking any further policy action. So thank you very much for doing that. Let me now request Sudipto for his discussants' comments, 5 to 7 minutes.
Thank you, Subhash. I should start by saying that one of the authors who just presented, Poonam, and I have been colleagues together before, and we have commented on each other's papers. So she was just telling me outside that, oh, this is payback time. It's not payback at all. This is actually a very impressive paper, and as is so much of the work that she and her colleagues do, it's very detailed, careful analysis of data to answer a very clear set of questions. But I will not have much time to go into too many details because we have very limited time. Basically, as we saw, they look at three sets of things: the long-term growth dynamics, the three interestingly identified phases of growth in the economy, and the challenges going forward to maintain high rates of growth, which she concluded with. However, let me say that while I basically agree with most of what has been said in the paper, and some of us have been also asking these questions and giving similar types of answers, whether it's investment rate changes or openness and so on. But in a sense, these are fairly conventional answers, very carefully done with the careful analysis of data, as I said. But I want to present a slightly different way of looking at the growth story, only to really encourage an interesting discussion. But firstly, let me start with a question about the data. When Shekhar first asked me to comment on this paper, I was very intrigued about how the authors would tell a long-term growth story of the Indian economy when you actually don't have comparable data prior to 2011-12. Because we changed the base year of our GDP statistic that year, and usually when that happens, the CSO, the statistical organization, generates the back series so that researchers and analysts have a long-term series to do time series work. In this case, this was not done, partly because the new database that is being used, particularly the corporate balance sheets of the Ministry of Corporate Affairs, just not available prior to a few years. So I was curious, and what actually the authors have done is generated their own back series. It so happens that the National Statistical Commission appointed a committee, which I happen to be chairing, which has been one of the things asked to do is to create this back series, which has been missing so far. And this work has just been finished. It is, in fact, as I was telling Shekhar, it is actually going through the internal processing in the Statistical Commission, and it will probably be in the public domain next week. just a week too late, but maybe when you all are revising the paper, you can have a look at that. What I can do here, just give a comparison of two ways in which the backcasting has been done. In both cases, the growth rates of the old series have been preserved, which is something desirable, and that is linked to the new higher GDP level in 11-12 in the new series. The difference is, and I haven't seen their numbers, they're not carried in the papers, my assessment is that in this case, the adjustment level is backloaded onto the base year. Because after that, the growth rates are maintained and you come to the higher GDP level in 11-12. In what we have done in the committee is that also maintain the growth rates, but then very incrementally adjusted the output level so that you end up with the same 11-12 output as in the new series, but it is more smooth rather than a one-time shock. So the implicit assumption underlying these two different approaches is a one-time shift in production, which is a gradual change in the production structure or production basket, and we preferred the latter. Let me now go to their part of the paper where they discuss the long-term dynamics. And just bear with me for a minute on the following thought experiment. You have two sectors, one which is faster growing, less volatile and has higher productivity, and another which is lower growth, higher volatility, lower productivity. Now, if this process is repeated over a number of cycles after 10, 15 years, you will see that the production structure of the whole economy has changed completely. There's no change either in productivity or growth or anything internally. Yet, you will see the overall economy, the growth rate has accelerated, there is less volatility, and productivity has gone up. Exactly the three main long-term trends that have been picked up in the paper. Now, the reason why I'm saying this is not because other things like changes in technology or products or policy and other shocks are unimportant, but only to make the point that all those need to be loaded onto or laid over these underlying long-term structural changes that would have gone on in any case without all these disturbances to complete the story. Let me now refer to partly looking forward and what's to come later. Based on the long-term dynamics and the higher granularity three phases that they have looked at more carefully, and including the higher frequency period for the last couple of years, a number of factors have been identified by the authors as the drivers of growth. I think there are 5 or 6 factors. And here, along with things like India's low dependency ratio, the investment rate changes, or the degree of openness changes, they have also talked about reforms. Now, in fact, the structural change story, which I just said, talked about earlier, together with the dependency rate in India and how that has been evolving, the investment rate rise and decline, and the degree of openness changes, which are measured in the usual conventional ways, can completely explain everything that's happened, including the slow period of growth prior to 1991, actually prior to the mid-80s, the subsequent slow increase in growth, and then the very sharp increase in growth between 2003-04 and 2007-08, and the subsequent slowdown post the financial crisis, which Poonam has described, without ever mentioning reforms. Now, this is not to suggest that reforms are unimportant. Well, all of us have done this in similar types of papers or books, but it's just to make the point that reforms are institutional changes, or if you will, in the regulatory framework, which are occurring at a different plane and should be kept different, I think, from the story of the growth dynamics and the proximate macro variables that we talk about, namely the openness, the changes in investment rate, and dependency and so on. And all this has this underlying story of reform which needs to be treated separately in my view. And that's all I will say. I have lots of other comments which I can share with you bilaterally, Poonam. Thank you.
Thank you, Sudipto. Thank you very much for those crisp comments. May I now request Dilip ji for your comments?
Okay, so my disclaimer, I've never worked with Poonam. There's no payback here. I'm not a macro person, especially short-term macro or macro data or Indian data I don't know much about. So I'm very much of an outsider here. So you might wonder, what am I doing here? You should ask Shekhar. I'm going to do my best to just reflect. It's going to be a stream of consciousness reflections. Very much enjoyed the paper. Part one of the paper provides an interesting set of facts pertaining to long-term growth, particularly acceleration. I'm going to talk about that bit. And also a reduction in growth volatility, which I think economists actually have a hard time understanding. There's very little literature on growth volatility in a development context. So particularly interesting I found were the comparisons with the EM7. It was sustained and uniform across states in India. And what it seems to be associated with is rising investment, rising role of the service sector, importance of credit, trade, FDI, and productivity growth. And one of the things this tells me, there is the school of structuralist macroeconomics in India, and clearly in terms of long-term growth, they have absolutely no leverage here. So agricultural growth, domestic demand, and public investment seem irrelevant. And I actually corresponded with some of my friends who are in that school, and they agreed with me. Also irrelevant, what they show in the paper is reallocation between agriculture and industry or human capital growth. The second part of the paper is completely different, a granular short-term perspective since 2007 and the effects of the financial crisis and thereafter. And as I read that part, the theme was somewhat at odds with part one, as Sudipto mentioned, the three phases, slowdown in investment, exports, credit quantity and quality. And here the structuralist factors seem more relevant, short-term sense. And the tension between parts 1 and 2 is that this suggests that the acceleration was a one-time phenomenon and that it may be difficult to sustain in the years ahead. Now, my reactions. The larger question about acceleration, is it sustainable or not? That's, I guess, the policy question here. Now, if you think about that, obviously acceleration cannot be indefinitely sustained, okay? The growth can't just keep growing. At some point, it's got to stop. However, despite slowing down over the past decade, it's still been hovering around 7% the last few years. So the long-term trend is definite, and certainly double the pre-1990 Hindu rate of growth, which used to be about 3.5%. There's been a similar slowing down in China recently, also tending to a similar average of 7 to 8%. Now, as I sit back and think about 7% growth, it is really astonishing. It is a miracle. And sustaining it over a couple of decades is extraordinary by historical standards when you look at Western Europe or the United States. So the question is, even as the acceleration may cease, will growth rates stabilize, at least for the time being, for the next decade or two, at around 7%? That's the question. Thinking about the comparison with China, in my mind, one of the big mysteries about growth in India, at some deep level, I think, I don't understand it at all. I mean, think of the India-China comparison. A lot of the constraints that operate in India don't seem to operate in China. Frictions and regulations in land and labor markets, weak governance, especially urban local governance, grabbing hand rather than helping hand, poor infrastructure, low human development, low rates of R&D. If you compare the patent rates, it's apparent, spending on higher education and research. Both have weak judicial contract enforcement mechanisms. So then how does India manage to achieve a growth rate which is, in the neighborhood of what the Chinese are achieving? And significantly higher than emerging markets. So I'm not an expert on data at all, but I do pause to wonder about how credible the growth of data is. And others have much more expertise on this, Sudipto mentioned. However, I think, the changes in the national income accounts, I think, have been only relatively recently, the last 4 or 5 years, so it shouldn't really affect the long-run perspective. Besides, we're really talking here not about levels. We're not even talking about the first difference. We're talking about the second difference. So it's not clear that these measurement issues are going to be that important. In terms of the explanations, I guess, the investment data may be less reliable because, TN has reminded us that it is a residual in the national income accounts, the standard price deflation aggregation issues. I think the unorganized sector is interesting and important. Sudipto also suggested that, if you have his thought experiment, and I perfectly agree with that. So if you have an unorganized sector and an organized sector, just as he described, and you have increased transition from the unorganized to the organized sector, it may account for some of the acceleration. Now, the authors make no attempt to fit any kind of a growth model to the data, nor provide any conceptual framework. And as I mentioned, we're really talking not even about the growth rate, but about the change in the growth rate, okay, the acceleration, and second moments. Now, most growth theories deal with the first derivative, the growth rate, and mostly in the long run. Now, what about neoclassical growth models? They seem quite irrelevant here, apart from solo-style growth accounting, which is not really a growth model, which is, it's suggesting the importance of investment rates and productivity growth. Now, in the solo model, the long-run growth rate is driven by productivity growth, but it's entirely exogenous. And in the short run, you get growth deceleration rather than acceleration, assuming that the investment rate is constant and the productivity growth is constant. So acceleration is consistent with the neoclassical model, provided you have fast enough increases in the investment rate and productivity growth. But then we need to understand what's driving these, and that's missing. So endogenous growth models are perhaps, more appropriate. They're based on spillovers that generate dynamic increasing returns in the aggregate production function. Spillovers are what? Well, the early endogenous growth models were about R&D or human capital, but the data seems to suggest neither would be relevant. So perhaps it's spillovers in the adoption and diffusion of technology. The international frontier is more accessible owing to the trade FDI openness reforms there helped, and some of the supporting evidence, Goldberg, Pavnik, and Khandelwal. Agglomeration externalities is another possibility emphasized in economic geography models, and these externalities involve sharing of key inputs, market access, and the diffusion of know-how. I'm not aware of many empirical studies of such agglomeration in the Indian context. Some students of mine have been estimating the effects of special economic zones that may have been sort of encouraging these spillovers. I also came across a paper by Balakrishnan, Das, and Parameshwaran, which was published last year, which was an endogenous growth model dealing with the interaction of the services sector, particularly producer services and manufacturing. And the producer services sector is subject to increasing returns to scale because of fixed costs. And the dynamic complementarities you can get between the two sectors, and they actually do take it to the data. So I think that's interesting. What I want to talk about to end my remarks is the possibility of community-based networks through which spillovers occur. Production clusters, for instance, are important in both China and India and specific industries. And we have lots of case studies in China, Long and Zhang, for instance. And in the Indian context, Abhijit and Kaivan Munshi did this work on the Tirupur garment sector. These clusters involve collection of small firms with a high degree of specialization, extensive subcontracting, and pooling of capital and risks. And they have achieved extraordinarily high rates of growth. And these clusters have overcome weaknesses both in markets as well as institutional weaknesses in finance, contract enforcement, and access to know-how. And in both cases, they seem to be organized on the basis of social community origins. So in China, it's the combination of hometown and clans work here. And in the context of India, most plausibly associated with caste. And Kaivan Munshi has done work on a number of industries. Now, the empirical analysis of community network-based agglomeration is limited by data availability because these involve small firms, and quite often the data that you have on firms does not include information about the social origins of their entrepreneurs. Spillovers are hard to estimate, so they have to be inferred indirectly, and quantitative studies are typically limited to specific industries and locations. And in India, there have been studies that Kaivan Munshi has done on garments and on diamonds. Some recent work I've been doing with Kaivan Munshi, with some co-authors in China, we managed to actually get data for all firms in China and use that to study the evolution of private enterprise. And we estimate rural county-based community networks based on this sort of hometown clan connections contributed approximately 40% of all entry and capital investment in private firms between 1990 and 2009. So I think analogous studies of this kind in the Indian context would be valuable, and we are making efforts to organize data from the Ministry of Company Affairs. Just to end my remark, what does this imply about the sustainability? Growth spots are limited to specific community networks. And so there is a certain sort of limit to sustainability there. Chinese production clusters, so some additional problems of sustainability. Chinese production clusters were oriented towards the domestic market largely. And export-oriented production tends to be vertically integrated. And so the early Chinese growth was oriented towards low-end manufacturing with low requirements for know-how, education, and capital per entrepreneur. And there are also limits to the growth of the domestic market, and there's a rising demand for product quality. All of this creates a need to upgrade quality to sustain the growth process. And so these, I think, similar problems of improvement of quality are also going to confront the Indian IT sector. So the challenge to maintaining 7% growth, part 2 of the paper narrates problems with sustaining high investment rates, exports, and improving credit quality. To this, I would add other structural constraints, resources, pollution, limits to IT export growth, low-quality urbanization, rising inequality and political pressure to redistribute loan bailouts, and so on. So I agree it will not be easy, but we economists tend to be pessimistic by nature, and if you asked economists in the 1980s and the 1990s, always the outcome turned out to be better than what we had predicted. So I don't think we're very good at anticipating some of the the spillovers, the underlying sort of drivers of growth. Thank you.
Thank you, Dilip. Subhash had to leave. The finance minister is not well, and so when he has to meet his officers, they actually, even at his residence, talk through video conferencing because he has to be in an isolation area since he's still recovering from major surgery. Floor is open. We've had 2 very interesting and very different comments by 2 discussants. Dilip, you did exactly what I had planned you would do. You looked at the micro foundations of growth, which is where I think we also need to do a great amount of work. So I see a lot of hands up. I'm sorry, I didn't see who was up first. I think we'll just go from this end and then come around. Pranam?
Yeah. No, my comment would be quite marginal to the presentation of the paper. In fact, my comment would be much related to comments by Dilip. First of all, anecdotally, I've often talked about this with others. We economists tend to try to relate or succeed or don't succeed in relating reforms to the long-run growth performance. But coincidentally, at the same time, say from middle 80s onward, the reforms that have taken place, at the same time, a big social change has taken place in India, which is the hitherto subordinate castes have come up and become politically more assertive, but also economically more active, because barriers to entry as they have fallen, these new uprising caste groups have entered business, and mostly small business. And I think we economists have so far not tried to quantify the impact of that on the growth dynamics. And in a sense, this is related to Dilip's comments toward the end. But there, I would say, the data to look for will be not so much the company data that Dilip you have mentioned. I think much of the impact is in what is still the informal sector. And there, hopefully, we now have more data. You know, the NSS have been collecting data on manufacturing sector. But more recently, NSS has released the total unincorporated enterprises sector for 2 years, 2011-12 and 2015-16, the reports I've seen. It will be useful for further studies to relate these households, if one can get hold of the data, it's not easy, to their social composition of these households. And I have a hunch that much of this is related to this up-and-coming subordinate caste who were peasants before and then entering this, and in a sense, the Abhijit and Kaivan's paper about these Gaundas in Tirupur, these were peasant castes, entered business, in a sense invested agricultural surplus into this. So what I'm essentially making, not essentially, it's a general point, that I would like more studies relating the social composition of these groups and their business investment, but largely in the informal sector, which is the data issue. Thank you.
Surjit.
Hi. This is a rich session because both the paper as well as the discussants had very, very important and good points to make. So I have a comment each, if you will, on each of the three presentations. The first one, in terms of the investment rate going down, if you look at, a lot of stuff has been happening around the world for all the countries, and I think as economists we need to be, empirical economists, we need to be very, very careful about the deflator. So if you look at in real terms, investment goods the price of investment goods hasn't gone up as much as the price of other goods. And therefore you find that the investment rate is going down if you measure it in nominal terms, both the ratio, both the numerator and the denominator. If you do it in real terms, the decline has been about 3 percentage points. So maybe there's not much of a story there, and it's still very, very high. On the share and export growth, I looked at the graph, and it'll be nice to get, the goods has plateaued and the services gone up. So share in world trade, both goods and services, looks like it has gone up and is not stabilized at all. So that would be nice because you've got share in services, world services, and share in world goods. Add the two together, I don't know what it'll look like, but my suspicion is that that's continued to go up. On this base year business, and I'm really looking forward to that presentation or that paper. When I last looked at it, when the data came out, essentially 2/3 of the economy had virtually no change in measurement. And the two areas that went through almost a symmetrical change was trade, hotels, and restaurants, whose share came down by about 5 percentage points, and industrial growth, whose share went up by 5 percentage points. What had happened was that in 2000, the way they used to do the national accounts before is looked at the growth rate given to you in employment from the previous time period. So 1999 to 2004, the growth rate in employment was 2.8% a year. So they assumed that for trade, hotels, and restaurants, the growth rate would be 2.8% a year, and actually it came out to be only 0.8% a year. And that caused the legitimate difference between what we have now, which is on the basis of taxation revenue from sales taxes. So I think there isn't too much, all of this hue and cry about GDP accounts being changed and therefore growth rate being changed and all the rest of it. I think, so basically I'm saying I'm really looking forward to your paper. Last on the, on what determines growth, and Dilip, you had, maybe it's human capital and then you dismissed it, but I think a large part of the story of China, well, China is a sui generis, so, but large part of the story of developing countries accelerating growth is a very, very large increase in human capital attainment or educational attainment. And we can argue that the quality is not so good, etc., but just the basics is enormous, and I think may have a lot to do with the acceleration in growth rates, which is tied to productivity that we have seen in many developing countries.
Thanks, Sujit. Devish?
Just some like clarification on Dilip's point on R&D. Actually, it's surprising that in the last decade, India has been the fastest growing country in papers published, globally. The new NSF report shows that India's share of global papers has doubled from about 2.5% to 5% from 2006 to 2015. It's now the third largest after China is number 1 now, the US is number 2, and India is number 3. Yes, yes, very much so. So this is from India, whether they are co-authors. Now, yes, in terms of quality, so if you look at the top 1% cited papers, the growth rate has been less, but even that has been growing quite rapidly. Not as much as China, but I've been very surprised. And in fact, if you look at India's now gross enrollment ratio in higher education, it's considerably higher than China's at a comparable level of income, when China was at India's level of income. Yes, absolutely we know about quality issues, but at least in terms of numbers on issues related to human capital and R&D, it's been a much more positive acceleration in the last decade than at least I had thought was happening.
Vijay? I think we'll probably just end at this stage and then ask the panelists to come back, and then we'll take this side. Vijay, please.
I have 2 or 3 comments. The first one is about the title of the paper, which is, I think it's called India's Growth Story. I really do think it should be changed to something like some macro aspects of India's growth story, because there is a lot more to growth than what this paper addresses. I mean, if we want to have, even to sustain 7% growth for the next couple of decades, I don't see how that can be done without addressing problems in the education sector, without reform of the state and of state capacity in institutions. And I mean, I can list 2 or 3 other things, but this paper doesn't deal with any of that. It deals with something fairly narrow, and I think that should be reflected in the title of the paper. The second point is that even within the scope of the paper, which is the macro, the long-term macro and then some short-term dynamics, I find the paper rather disappointing because it is too bland. It is too much a list of things, and without going more deeply into some of the obvious questions that might arise. For example, in the short-term dynamics section particularly, various questions arise. I mean, how much of the deterioration in the investment rate and the macro stability was due to increased fiscal deficits? Remember that that the crowding out hypothesis doesn't work all that well because it was a period of exceptional monetary ease. Real interest rates were extremely low immediately after the global crisis. So there is a question about how far fiscal deficits were responsible for what happened. and how much was other factors, including, of course, the debt overhang. Then the export growth, the paper just lists some factors. How important was exchange rate policy in what has happened? There's been a significant appreciation of the real exchange rate. Post this government coming in, there was an oil price bonanza. Could the oil price bonanza have been used differently? Would we have seen a difference in outcomes if that had happened? Fourthly, your investment rate diagrams show that actually after the fall in the corporate investment rate after the global crisis, it then shows remarkable stability. So what's going on there? Most of the decline after 2011 seems to be in household investment, not in corporate investment. Is that a story that we should believe? And if we shouldn't believe it, what's actually going on? Fifthly, what should we expect about revival of investment given the current state of the stress in Indian banking and what is happening in that sector? Now, and these are some of the questions that, it would have been nice if the paper had addressed some of these questions rather than giving us a sort of a bland description. And here I'll make another point, which one normally shouldn't criticize the references that the paper cites. But since I actually discussed some of these problems in my book, and I didn't find a reference to my book, which have slightly irritated me, let me just say this. I then looked at the references. There are 50 references. Of these, 30 have nothing to do with India at all. They are to do with growth, sort of literature on growth, name-checking various people. There are 5 references which are by the authors themselves. There are 10 references which are by either officials of the government of India or previous officials of the government of India or international organization reports. There are only 7 references out of 50 which don't fall into any of these categories. Now, it seems to me that the authors should read a little wider and also read some Indian newspapers, because many of these topics have been discussed outside the narrow reading list that the authors seem to have consulted. So with that, let me end by saying the paper is excellent. Within the confines of what it does its job very professionally. But I have to confess that I was a little disappointed by the blandness of it. Perhaps it originates from the fact that all the authors are in the World Bank, but maybe they could have broken out of that straitjacket a little bit more than they have. Thank you.
I'm almost tempted to respond. I'll wait till the end.
No, let's hold your horses and let's get Sajid, and maybe he has a different view, but you will have a chance. We have enough time for this session, so surely, and this is a very rich discussion. So Sajid, please.
Thank you very much. I want to say it's a very comprehensive overview of India's growth dynamics. Let me make 3 comments, go from kind of narrow to broad, just to pick up on where Dr. Joshi left off. I think a slightly deeper dive into India's investment dynamics in the last decade would add a lot of richness, notwithstanding the points that Surjit made on measurement. If the presumption is all of this is large corporate investment decline in the last decade. And if we just fix our banking system, we'll be back to where we were a decade ago. But if you look at the data very closely, a lot of it is household investment. That's actually fallen. So you've had 2 legs of the fall. The first was in 2008, corporate investment falling, but it's since stabilized and actually picking up in the last year as a percent of GDP. It's household investment that's fallen. Now that's a catch-all, I think, both for households and I think for small, medium enterprises. And that's been falling for the last 5 or 6 years, well before demonetization and GST and efforts to formalize the economy. So the question is there a more existential problem that SMEs in India are going to face and how does that affect investment dynamics. And the implication is you can fix your banking system, but without changing the economic viability of these smaller enterprises through factor market reforms, for example, we may never go back to those higher investment rates. Second comment is really, if you look again at the last 6 or 7 years, there's an interesting dichotomy, because the kind of the golden period of growth that you referred to was a strong synchronization between India's growth and global growth. And I'll touch upon that tomorrow. But the last 5 years has been a desynchronization in both directions. As the global economy slowed for 3 or 4 years, India actually accelerated very sharply. And the last 2 years, as the global economy is recovering, India has grossly underperformed. So I think some exposition or thinking on why that's happening, one of the proximate reasons is what you allude to, is that for whatever reason, India's exports are not responding to stronger global growth. And in that sense, you get buffeted by the worst of all worlds. That in a stronger global environment, you don't get the benefit of net exports, but you bear the cost through higher commodity prices, which in India's case serves as an adverse terms of trade shock. So just, I think, some thinking on that, because you're seeing this for the first time in 15 years, this decentralization for over the last 5 or 6 years. I guess the third point is just this notion of, when I get nervous when I hear 8, 9, 10% growth for the long run, because if you go back to that period of 5 years of 9% growth, mechanically, I know this is a mechanical exercise, you can attribute all of that to exports. In other words, the entire slowdown from 8.8 to 6.9 in the last 5 years is attributable to the slowdown in value-added growth of exports. So the question is, if this is the new normal, right, how do we even sustain 7, let alone 9? And that goes back to Dr. Joshi's points about what are the other kind of drivers that you need to drive growth without stoking external imbalances, which was not a constraint when this was export-led growth. But I'll just stop there.
Poonam, we have 4 more flags up. Do you have energy to take those in, and then we'll have a very nice period of time for you and others to comment on?
Yeah, I can tune out where I want to. So.
Okay. Abhijit, I think yours is next. I hope I'm not missing anybody at the other end. Yes, Abhijit, please.
I guess Sajid picked up on one of the points I was going to make, which is that I think what we call the household sector actually includes lots of what are other, with the other measurement system we would call firms. And so I think that part of, what we're picking up is exactly that. Now, which is the decline in investment in the household sector. Now, I guess I want to say, it's not obvious to me that whether that's good news or bad news. And I think one of the things that is worth commenting on about this 2003 to 2008 period is that suddenly you see that the new startups are bigger in India. One of the striking factors in India is how small firms are relative to the industry, and that's one of the things that's shifting exactly in that period. So I wonder if we are now finally the corporate sector, after sort of taking a bunch of hits, is back to trying to go back on that trend of increasing just plant size. And we have some of the most remarkable, if you put India on a global sort of GDP map, India has the smallest plant size. It's sort of one of the facts and so I think one of the things that's perhaps, so I don't know whether it's a good news or bad news, whether the investment, if the investment is moving towards the corporate sector, not worrying about the level, just the shift, is that good or bad? I suspect it might be good news rather than bad news. But the other question I had, which is something I would have thought a paper like this should take on, which is sort of, I don't understand the fiscal arithmetic of India at all. I mean, where is it going to, all the off-balance sheet borrowing, all the kind of, the sort of deficits of the states, all of those things, when is the arithmetic going to converge? What's the thought which sort of allows us to, meet our deficit target by 2024 and also our debt to GDP ratio target by 2024 and keep, you know, all these bail out the banking sector, let the states behave as badly as they're going to continue to behave, and where's the money going to come from? What's going to give? And I would have loved to have seen a discussion of, you know, when sort of thinking of kind of in the barrow mode of growth, which is that there's a future and at some point things have to land. I don't see any discussion of the landing problem. And I think, I mean, I think we could go back to what we did for a very long time very successfully, which is run very high inflation rates and financial repression. That would be my pick if I had to see where how we'll go back to, you know, stability. But it seems like we should be discussing this in some form or the other.
Okay. Let's see. Ila, I think you were next, and then Govinda, I'll come to you in a little bit. Just let me finish this round, and then Ila.
I want to take up further on the point that Sudipto made on the formal and informal sector. Now, what you have in the paper is that in the short term, these are the things that are not doing well, you know, whether it's investment or other things that are not doing well, and what would be the challenges looking ahead. I was wondering if what we could also have, and I would love to see that in the paper, is some of the recent initiatives which might have a deep impact, such as something like GST, or, you know, the misguided demonetization, but attempts to make the economy more formal. Now, some of the data that one is seeing could perhaps, and that's not, you know, something I've worked on, but perhaps one could look at it, is perhaps supporting the hypothesis that some change has started. So we've seen a sharp decline in informal sector jobs after demonetization. We are seeing small firms, perhaps a lot of them informal, do badly. We are perhaps seeing an increase. Now that Ghosh and Ghosh study is very controversial, so I don't want to, you know, say that that is the last word on jobs in EPFO, but we are perhaps seeing an increase in jobs there. My question really is, could we have a discussion on what are these reforms that perhaps could lead to this transformation of the economy at a faster pace from the informal to the formal sector? And what are the implications for the short term, and what are the implications for the long term? Because in the short term, usually such changes are disruptive, and you would likely see that many sectors don't do well. Whereas in the long term, if this means an improvement in productivity, so the sector that has higher productivity, then does that mean that it does well? So that's it.
Shanta.
Thanks. Actually, the biggest surprise from this paper, so that's a statement that is not so bland, to me was the balanced growth, both the balance across sectors as well as the balance in space across states. Because I'm trying to figure out how to reconcile that with the unmistakable increase in inequality that we're also observing during this period of growth. And I guess this is reinforcing Dilip's point that is there a underlying growth model that can explain both the balanced nature of the growth as well as the increase in inequality? Because my instincts are usually that it goes the other way.
Karthik?
There's lots of comments. I'll just keep it to one. And it combines something Dilip said, which is, you know, in terms of what kind of model do we have underlying all of this. And so it's unfair to almost ask for a second paper, but I really feel that this kind of analysis it doesn't need much more data, but it would be amazing to just see the same thing done at the state level, right? Like, I mean, so I think that's where we'll get a lot of clues to the questions being raised over here, because in the end, if you just do India, like, I mean, it's one case study and it's just like overdetermined, right? I mean, we have no idea everybody has their pet theory, and at some point the EM7 comparison is useful, but I think the real way to push this kind of, the analysis forward, not just descriptively, but perhaps hopefully starting to shed some light on policy correlates, would be to kind of take the state level variation story really seriously. And I would just love to see that.
Last question from Govinda, please.
Thank you. Very interesting paper. But I think one of the, sort of off-scene phenomenon is some sort of a 8 to 10 year cycle in the Indian growth story. And that happens usually with the pay commission award and the oil prices. You'll see that. In practice, in 1977-78, you had the implementation of pay commission award, and in July of 1978, oil prices skyrocketed. And your global financial crisis came much later. The pay commission implementation, the expansion of national rural employment guarantee, and loan waiver were the three major things in the 2007-8 budget. The consequence of that was a sharp rise in fiscal deficit. In fact, you see in 77-78, if you see, the aggregate fiscal deficit was somewhere about 5.5%, center plus state taken together, 3 plus 2.5. 78-79, it became almost 8.9%, 9%, if you take into all these things together. And subsequently, you rightly said that, our fiscal problems still continue to persist from then on. But the growth, you get a lot of this insights into why there has been a decline in the investment. It's much more to do with our own domestic policies than with the global financial crisis. I'm not saying that global financial crisis did not impact, but we have messed ourselves. That's some of the things. I think that has to be. I think that your story will get much more, traction, if you get into these issues. And then this problem of 10-year cycle of pay commission and oil prices has continued. It had happened in the 90s, sort of when we had the crisis in 89-90, and then it's happened in 2000, and then again 2007-8.
Thank you, Govinda. Any further questions? No. So, we have lots of time to lunch. So,
Lots of
Poonam,
okay.
and you have a very rich set of questions, including ones that I know you're keen to.
Okay, it's okay. So I'll just reflect a little bit selectively because the comments cover a very, very wide spectrum, and almost all of them are relevant. It's a question of where do you draw the scope of the paper. And we had to decide on that. And it's the second version of the paper for the IPF. The first version was for a report that we bring out in the World Bank called India Development Update. And that had a slightly different scope. And some of the questions we received today actually are the ones we thought will not be of interest to this audience, so we took them out. And we are happy to bring them back in. And these include actually reform story. We had a slightly stronger one. Not just that, we are very much aware of the importance of reforms. Reforms are a continuing process, right? You stop reforming, perhaps you stop getting that extra kick on growth, or you stop accelerating. So it's not a one-time story, but what we also did is we put in an effort to list all the reforms. We divided the economy and the reforms into 6 main sections. And Dhruv, who's sitting back there, he painstakingly has documented all of those reforms. What is difficult in that exercise is to actually pinpoint periods of high growth exactly to when reforms are happening. There is an important lag effect, there is cumulative effect, there is interaction across sectors, but this is not to say that reforms are not important, but that was the challenge, and we'll bring that back in. And similarly on growth models, we actually work with Neoclassical growth model, and we had a discussion running into several pages, which we in fact took out even from our earlier version because the paper was getting into 70 pages, and we thought it's not needed, we'll bring that back in if this is what the referees and the editors decide and ask us to do. One question that I'll reflect is on India and China. Dilip, you said that India's and China's growth rates are similar. This is despite their policy frameworks and challenges being vastly different. In fact, my take is that India and Chinese growth rates are similar only in the last few years. China has grown much more rapidly, having taken its income level to 4 times the Indian income level despite starting at the same levels 4 or 5 decades ago. So the fact that the challenges are different and India has not navigated them fully is reflected very much in the kind of growth rates China had and the kind of growth rates India has had, as well as in the sectoral composition of their growth rates, right? Manufacturing depends much more on removing exactly the kind of challenges you talked about. Since we are talking about sectoral growth, let me here address Shanta's comment on how to reconcile it with inequality. I think my take will be, when we are talking about balance, it's about there not being any glaring issues of imbalances, but at the same time we saw that agriculture is not a story of acceleration, services is. Perhaps inequality can be explained in terms of those to the extent the services are high skill intensive, etc., and this is what people are talking about. So perhaps these can be reconciled. But in my mind, at least, if not in the mind of the co-authors, you know, when we look at other large emerging markets, you see some inherent dynamics which indicate that there are imbalances, whether it's commodity dependence, whether it's a democracy failing. You know, look at Turkey, a well-growing economy becoming increasingly more autocratic. So, but when you look at India's 50 years, you don't find those big shocks which can dent the growth story. I think that was the bigger point that was being made, that it's not just dependent on resources, it's not, you know, in terms of the right-hand side correlates that a neoclassical growth framework or another growth framework will give, and we talked about the importance of human capital, etc. Most of those correlates are improving over time. One can complain about the pace of those improvements, but not necessarily the directions. And this is how we look at it. But we will reflect more fully on these factors in the revisions to the paper. Now let me see what else. On the story on fiscal deficit, which came out at 2 places, Vijay as well as Abhijit Banerjee, absolutely. This is a story we haven't reflected on fully in either of the versions of this paper, and we are happy to bring it back in. On fiscal arithmetic, actually, so what will make deficit sustainable or debt level sustainable? I think a high hope there is from tax revenues increasing after GST. Hopefully the quality of expenditure. And on debt to GDP, it's the nominal GDP growth besides deficit itself. So I think this is how the story is likely to square up. And despite the fact that we can find a lot of fault in the way fiscal policy is being conducted, the fact remains that fiscal deficit has declined for most part in the last 5 or so years. So deficit levels currently at 6, consolidated deficit at 6.4, they are down from I think 9 or something in early around 2010 or 9. I'm not very good with numbers, others can correct, but there has been a definite decline, and debt to GDP ratios have declined as well. Arvind Subramanian has written about it primarily because of nominal GDP growth. But an added feature will be, hopefully, revenue is going to increase, and there are early indications that more people are registering as taxpayers, and GST tax revenue, I think, is not too bad either. So with increased formalization, with whatever things this government has done, crazy or not, hopefully the tax base will increase. So let me come to Vijay. I'm saving the best for the last, so I'm just coming I won't quibble on the references list. I think I have 2 copies of your book in your room, so it's a pity that I didn't. One was bought and one was gifted. So the earlier version of the paper prominently actually had cited on the first page itself your speech at the RBI, which we circulated in a large organization called the World Bank, and we read it with a lot of interest. We'll certainly bring that back in. But on and your book as well, of course. I don't think I plan to take away any of my references. I think that's the way this game is, so I'll keep them in if you don't mind. World Bank has nothing to do with it. You can do different if I was citing the same amount of my papers before I joined the World Bank. So, on other issues, on a serious note, yes. Exchange rate, oil prices, all of these issues should figure in more. Fiscal deficit, I just explained, and the only challenge there will be, some of these issues are more topical. The way I think we looked at the paper was we wanted to give it some kind of a balance across these long-term, medium-term, and short-term. And if we expand on each one, we are really looking at a paper running into 70, 80 pages. And if the editor and the referees are okay with it, we'll try to conserve somewhere. You talked about imbalances. Actually, we had a section on imbalances leading up to 2013 tapering talk period, which didn't find its place in the revised version. So that's a choice we will have to make. On corporate investment versus household investment rate, it's a very valid point. And I don't know how to look at household investment rate. I haven't thought about it. Have certainly thought about corporate investment rate, and we are working with firm level data and looking at some of the hypotheses that we have in mind, including whether it's high leveraging of the 2003 to 8 period that's resulting in a correction, or maybe there's no correction. Actually, a couple of friends just talked about that there is no correction in corporate investment rate, but this requires some investment, and we will be working on it. On Karthik, your point on actually exploiting state level data more, we have done it quite a bit, and we are able to take it forward. So the kind of hypothesis we are testing, not just whether growth acceleration stability is present at the state level, but the hypothesis on boom-like features and they resulting in a slowdown. This we do at the state level. Diff is actually done there. We identify states which had a very rapid pace of credit growth prior to the global financial crisis, and we see that exactly those states are the ones which are slowing down. And then we look at other characteristics, whether it's an agriculture dependent state, whether it's a poor state versus rich state. So some of these are coming out there. But if you all collectively feel that we need to flesh that part out more, we are happy to, but we'll look for your guidance on how do you want us to balance the paper out. I think many of them I have taken. If there is a compelling one, which, and if I have the answer, I'll be happy to.
Thank you, Poonam. Just listening to you, I could imagine the framework for a book, because that's what it kind of felt like with all the rich comments that you got, plus also state focus, and then all the things that you left out. And I have to say that I'm partly responsible for guiding the authors to ensure that we had a manageable paper. But I think there's a lot more that we should talk about, and certainly you and your colleagues at the bank, and Shanta is here, so he can also support that, should do. Dilip?
So just some short responses to comments. So Pranab, I agree with you entirely. And in fact, even with the company's data, which actually includes information about the names, and from the names we can back out the castes, we are actually seeing exactly what you conjectured. That you see a rising entry of lower and OBCs in particular. People who, caste groups that have never been associated with private enterprise. But it would be lovely to be able to use NSS data. I mean, I didn't expect to see it in the companies, registered companies' data, but it's there. But I would expect it would be certainly accentuated if we had data on all the other firms. Surjit, I don't know about how important human capital has been in the Indian context. My sense is that it's a lot less important than it's been in other countries, but the remark that I was making was based entirely on the data that is presented in their paper. And I guess there may be issues about how it's being measured, particularly the human capital dimension, but I think Poonam would be better placed to respond to that. Let me just remark finally on, I think point that Abhijit raised and Shanta raised. I think you think of this as a non-convexity in a production function, that large firms have higher rates of return than small firms, which is at the basis of, I guess, what Abhijit was suggesting. So one plausible hypothesis, which may also explain how you have rising inequality, and yet you have balance across states and so on, is that you've got a change in the size distribution of firms in favor of large firms within sector by sector, state by state. And in fact, I'd done some work on the debt recovery tribunal, the reforms in debt recovery in the 1990s, using a double diff method across states as the reforms were being phased in. And what we found was that it resulted in a substantial redistribution of credit. The top quartile of firms, this is using the CMIE database, the allocation of credit expanded very substantially to the top quartile, and it contracted for the rest, and particularly the bottom half of the distribution. When we used that as an instrument to calculate the rate of return on investment, I was astonished to see how different the rates of return were. And in fact, the differences were so large that I couldn't understand or explain them. And so I never published that paper until I found a credible explanation for it. But it's certainly there in the data. And so that is a possible explanation. And the work that my students have been doing on the special economic zones, they also see this shift from the unorganized to the organized sector, which is also consistent with that.
Sudipto?
Just two comments. First of all, Surjit, you were asking about this the new data series, which will hopefully be in the public domain. I'm afraid it will meet only partly what you're expecting. In the sense there'll be some disaggregation. Basically, it's the macro series has been projected as a first cut. But what is going on, unfortunately, they have not got their act together. The National Accounts Division is using the new the new methodology that they're using for the 11-12 forwards thing to backcast for a few years, and they're also using where they haven't got it some CMIE data and so on, but they can't go back very much. You'll get the richness you're looking for maybe for another 4 or 5 years going back, but not a long time series. The other comment I had is that, listening to everybody starting with Dilip and then Pranab's remarks, to some extent Vijay's remarks, and so I think Sajid, certainly Abhijit, and finally some of the comments that Shanta made and also Karthik. I think Ila also mentioned that there seem to be two different types of dynamics that have been at work, one for the informal sector and one for the formal sector, and some interaction between the two. And there was an observation that maybe the informal sector was, moving very dynamically earlier, but has been some pushback more recently, perhaps following the demonetization and GST policy shocks, which may have hurt them more. So I think that certainly needs to be looked at more carefully. And as Pranab mentioned, though this was a big black box, this informal sector, the unorganized sector, there has been some very positive developments on the data front. He did mention the unincorporated enterprises survey, which first looked at manufacturing industry, later looked at services, and now the NSS is bringing out combined surveys every 5 years for the entire unorganized sector. It's a fairly large and well-designed sample and so on. So hopefully we'll have at least a better database to address this very important question of the formal, informal sector and how that dynamics is playing out. Thank you.
Okay. This has been a very rich session, much more than I had thought we would be able to get to. And I'm actually glad, Dilip, that we requested you to be a discussant, because I think it's opened up a whole discussion around the informal, formal, which Sudipto has just referred to. We've been doing some work on skills and the kind of vicious cycle that happens when informality breeds more informality, and then an inability to move into a formal sector, because the skill requirements and incentive frameworks for acquisition of skills isn't there on the part of the worker or the firm. But let me draw this session to a close. Thank Poonam and her co-authors. Dhruv is here, but the other two aren't, so please give them our compliments. Thank you very much for a very thought-provoking paper, and thanks to all the discussants and the panelists.